Sam, you've been doing this for a long time. Is this time different?
Good morning, Dominic. Well, certainly, I think that's a debate that's going on right now. Was the 50 basis point cut truly a recalibration or simply a way to ward off or at least smooth the results of a possible recession down the road? I think we're going to find in the near term that wanting is more profitable than having because the S&P gained typically about 18% between the last rate hike and the first rate cut. This time around, it was more than 23%. But in the following 1 month and 6 months, we were looking at returns that were anemic, less than 3%.
Sam, it kind of follows very recent precedent. We had talked on this show in the last few weeks about this notion that when the ECB cut its rates back in June, we did see some slowing momentum in certain parts of the European market as well. What do we think is going to happen for the balance of the year, given what we see as maybe the start of a regime change in lowering interest rates?
Sure. Well, I think we're not out of the woods yet in terms of seasonality. September and October are the two worst months of an election year, whereas August and September typically are the worst months in other years. So I think we could still see some more volatility, certainly today with the triple witching next week, and also as we head into October, which is about 35% more volatile than the other 11 months of the year. Yet once we see the lifting of the uncertainty around the election, November and December, all sizes, styles, sectors, and 97% of the sub-industries in the S&P 1500 have posted advances. So I think a little bit of caution right now, but then end-of-year rally, as is typically seen.
All right. And Sam, because of that, let's get into some of the picks that you have. What sectors do you like? Which ones do you stay away from? And are there any particular companies that you think are going to benefit?
Sure. Well, we look 12 months down the road. Our CFRA equity analysts are not looking at 12 days or 12 weeks, but rather a full year down the road. And we believe that because of the multiple rate cuts that we're likely to see over the next year and a half, that we're probably going to see rotation away from the defensives in the beginning of next year toward more of the leaders that we saw earlier this year. So communication services, financials, technology are our favorite sectors at this point in terms of individual companies.
Sure.
T-Mobile USA is one that we favor because it continues to take market share from its peers. We also like KKR, recently upgraded them to a strong buy because
Gotcha.
we think more rates will help the IPO market. And lastly, Microsoft should benefit from CapEx in the AI space.